Kevin O'Leary is worth more than $400 million and he's a very successful investor. Hence why we'll see how he invests in the markets and what you can learn from him to make better investing decisions. Kevin O'Leary is a famous investor known for his role in Shark Tank, where entrepreneurs come to seek investments for their businesses. He also founded O'Leary Funds and created several ETFs focusing on high-quality dividend stocks. O'Leary has always been investing in the markets and have publicly shared a lot of investment tips and principles that you can act on now. So get ready, fasten your seatbelt, and let's learn from Mr. Wonderful. My name is JC, and if you like this video, you should subscribe to my channel and like this video. That's really the best support you can give me and I'd really appreciate it. The first principle Kevin O'Leary follows when it comes to investing is investing in dividend stocks so as to create an income for yourself. Focusing on dividend stocks is a great way to make sure that a company is actually committed to their shareholders. It's a way to, on top of benefiting from a potential growth potential with the stock itself, well, you can also create an income for yourself by having those dividends on a regular basis. The good thing about dividend stock is that you can start investing even though you have a very small capital. There are plenty of very good dividend stocks that have been paying out dividends for over 25 years, making them dividend aristocrats. For example, AT&T. AT&T only costs a bit more than $30 per share, and even if you have a small capital, it's definitely affordable to at least have some shares of AT&T and start creating an income for yourself through AT&T. There's a saying that says that a stock that never pays dividends is only speculation, and regardless if it's true or not, we can only agree that if you invest in a stock that doesn't pay dividends, the only way you make money is if the stock goes up. So why not investing in a quality dividend stock like Johnson & Johnson, for example, where at least you generate a positive cash flow right from the start by receiving dividends? That's Kevin O'Leary's mantra, and I fundamentally agree with that. If you invest in a stock, you might as well get paid regularly for that. And obviously Kevin O'Leary is very heavy on dividend stocks, and even his ETFs that he has created, for example OUSA, is very big on dividend stock. I wanted to show you what Kevin O'Leary thinks about non-dividend stocks when it comes to investing in the markets. Because dividend stocks, on top of paying a regular income through dividends, they actually tend to outperform the overall market.
If you look at the volatility in the market around names that don't pay dividends, they're extremely volatile because there's no cushion of yield. What's the value of a stock that never returns capital to its shareholders? I don't know, because the only way you can make money is if somebody else is willing to buy that position at a higher price for some emotional reason perhaps, or for some foresight that maybe the company will return capital one day. And I think of when you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend paying stock is not good enough. Because let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either. So my tests in this index that I've created with FTSE Russell looks at the balance sheet. Every year we test to make sure that the company is viable in its ability to generate cash. This is extremely conservative investing. This is for the long haul. These tools are not for, as you're suggesting, for spicy, the hot stock du jour. I've done that. I've been there. Let the young legs do that. I have zero interest in that. I don't care what the hot new stock is. When a company comes public, I won't own it either. It's got to prove to me over multiple years that it can continue to generate cash before it even fits into what I'm doing. So I'm really boring, and I like it that way. I mean, I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it. So to me, that means about 28% of the market, to me, is just speculation. A stock that doesn't pay a dividend is a speculation. It's not an investment.
And that's a very interesting fact, that dividend stocks tend to have outperformed the markets over the long term because of this caution of safety that offer dividends. But of course, it's not because you invest in a stock that pays dividends that you are instantly going to become rich. There are other principles that Kevin O'Leary shares publicly, and that leads us to talk about his second principle, quality. Even though it might sound obvious that investing in quality stocks is better than investing in poor quality stocks, the need of making money quickly can very often overtake reason in the stock market. And O'Leary always focus on stocks that have strong financial with growth potential. Investing in a bad quality stock will eventually lead you to lose money on the long term. And even if a stock pays dividends, investing in a stock with bad financials is doomed to lose money. And to find quality stocks, you can go on O'Shares website where you can actually see the different ETFs that they offer, and you can see which stocks they're actually composing those ETFs. And investing in quality stocks like the ones that make up O'Leary ETF, for example OUSA, is definitely a good idea for investors just starting out, as those stocks have been around for a very long time and you can be almost sure that they're going to be around for at least 10 years. Although Kevin O'Leary invests mostly in stock paying dividends, that doesn't mean he doesn't invest at all in stocks that don't pay dividends. And here's an interview where he talks about why he invested in Tesla, which actually doesn't pay any dividends at all.
Well, you're also a value investor. Are these companies appealing now that they've gone lower?
Here's an example of one that's turning the corner for me that I'm actually an investor in, Tesla. Why? Because I can now see the path to profitability. I'm up 38% on Tesla. The only reason I bought it is my son got a job as basically an apprentice there, an intern. And I said, Trevor, on your behalf, I'm going to buy a bunch of stock because the stock down 13% today. They had a bad quarter. And within 6 months, the thing is now breaking even. It even looks cash flow positive in a quarter or two. So as a result, the market has regraded that stock and it's up over 30%. And I rest my case, Your Honor, it's turning into a real company that makes money for shareholders.
I want to go back to your point, your strategy on buying dividend stocks. Talk to us more about why you really only go for those dividend stocks.
So basically, I've gone back in history and said to myself, let me be a student of the past to define my future as an investor. And if you go back and look over the last 80 years, the companies that in the New York Stock Exchange, in the S&P 500, even in the Russell 2000s, the majority of the returns have come from companies spinning off cash and distributing it to you, not capital appreciation. We've had a great run in the market. In 2020, you're not assured that the stocks will go up in value, but if you have companies that have really strong free cash flows, you are assured those dividend yields, which are really succulent these days, 2.8 to 3.3%. That's way better than you're making on cash.
All right, one of your ETFs focuses on internet giants,
Yes.
top holdings, Alphabet, Alibaba, Facebook. What's your outlook for these stocks, and do you see regulation coming for a lot of these tech giants?
Oh, it's called OGIG, and you're right. It's an index I've created to not just get the FANGs domestically, but I want to own all the large growth companies on the internet. So I own everything in every market. And those companies are not as heavily regulated as our domestic. So as an index, I'm way better off owning the Alibabas and all the Chinese and all the South American players and all the European players, because they all have different levels of regulation. So this index is all the internet giants. And that's how I own the FANG stock.
As he says in the interview, even though Tesla doesn't pay dividends, he's invested in Tesla because he clearly sees a path to profitability now. And in my opinion, if you invest your money in the stock market and you want to speculate on stocks that don't pay dividends like Tesla, it should be a small part of your portfolio, so the bigger part of your money is invested in dividend stocks that actually produce an income on a regular basis. Because think about it, imagine that in 30 years we have a crisis like the COVID crisis that we have right now and you actually lose your job. Wouldn't you prefer to have a regular income from your portfolio because you have invested in dividend stocks 30 years ago and actually you can live off it right now, compared to if you only had invested in stocks that don't pay dividends, you wouldn't be able to support yourself on the very long term. However, investing in quality and dividend stocks can only bring you so far, because if you forget this third principle that Kevin O'Leary always shares publicly, it's obviously going to hurt you on the long term, which leads us to talk about the third principle, being diversification. Diversification is for O'Leary's very important, as it makes you avoid any big sudden loss. If you have 80% of your capital invested in only one stock and that one stock falls, then 80% of your capital is dragged down. Hence why Kevin is big on investing in diversified sectors so your risk is spread. However, it's important to mention that even though you might invest in several sectors allowing you to spread your risk, when a crash happens, most of the stocks will go down anyway. However, I believe that investing with a diversified mindset market is definitely a better way rather than going all in into one stock. When you look at all leary's ETFs that he has actually created, for example, OUSA, and you look at which stocks are actually composing this ETF, you can see that it's very diversified. OUCA ETF is actually composed of 101 stocks, with no more than 22% allocation per sector. The biggest holdings being Microsoft, Johnson & Johnson, Home Depot, Procter & Gamble, and it's definitely one of my investing mantra to actually be diversified. And if you're just starting out and seeking to invest in stocks but don't know where to start, it's in my opinion definitely better to spread your capital among quality dividend stocks and grow from there once you have more capital available. Currently, I have 37 stocks in my dividend portfolio, offering me a good diversification with a dividend yield of 3.92%. And for those looking to have diversified quality stocks, I think that investing in dividend aristocrats, meaning stocks that have increasingly been paying dividends for over 25 years, is a great way to invest in the markets. For example, ExxonMobil, AT&T, Realty Income Corp are great dividend aristocrats, and I've actually made stock reviews about them. And regardless if you want to day trade stocks or if you'd like to be more involved in the markets, it's important that you understand that having a long-term portfolio of stocks is very important for the long term. Because when you reinvest your dividends on the long term, the compounding effect is going to make your dividend portfolio grow and grow on the very long term. I hope you enjoyed this video where I talk about Kevin O'Leary's principles for investing. If you have any stock that you'd like me to review, don't hesitate to comment it below and I'll add it to my to-do list. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.